Are you so lost with money that it seems like everyone else in finance is speaking an entirely different language? Yep, I've been there. There is not enough financial information out there that actually explains things in clear English, let alone people from our generation who we can actually relate to. On top of that, if you do find someone like this, 9 times out of 10, they're from the States, which leaves us Canadians wanting so much more. So today I'm going to break down a top 10 list of financial terms and boring jargon from both the States and Canada that you should know. Welcome to the Ready Set Life YouTube channel. My name is Brittany and I am a millennial financial coach who makes videos all about taking the fear out of finance. Make sure you hit that like button if you enjoy this video and subscribe if you haven't already. I put out new videos every single Thursday and you don't want to miss them. One of the reasons I became a financial coach is because when I started my own financial adulting journey, there was little to no information that spoke to me. Everything looked and sounded completely boring. There was almost no one my age talking about it and nothing was in English instead of this fancy financial jargon. When I did finally find some people that I could actually understand, almost all of them were from the States. So I got even more confused because I never had heard of any of the things that they were talking about. What the heck is a 401k? Don't they have pensions? I keep hearing this acronym TFSA, but nobody's mentioning it. Is that just not a thing anymore? So whether you live in the US or Canada, by the end of this video, you will have a much clearer idea and understanding of what the heck this jargon actually means. And I know this video will be rewatched a lot probably, so I'm going to pin a comment down below with the time codes of each term. So feel free to watch it all the way through the first time, but then just hop around on the rewatches by clicking those time codes at the bottom. The first term that we're going to talk about today is interest. According to Google, interest is money paid at a particular rate for the use of money lent, or for delaying the repayment of a debt. So you can earn interest by giving money away, i.e. when you give the bank your money by keeping it in your account, or you can pay interest if you have a balance on any debts, like a credit card or a student loan. And there are many different and complicated ways to calculate interest, but one of the most important that I want to talk about specifically today is compound interest. Compound interest is when interest is calculated from the initial balance and then added also to that balance to collect more interest. For example, if you have $100 in the bank and the compound interest rate is 2% per month in this example, just to make it really simple, at the end of the month, you're going to have $105. And the next month, even if the interest rate stays the same and you don't deposit anything else, you'll have a balance of $110.25. And that's an extra 25 cents because now it's 2% of 105, not 100. Make sense? It may not seem like much at first, but think about an entire lifetime of compounding interest. The larger it grows, the more money that you get, especially if you start adding that balance regularly. That balance could skyrocket by the time you actually need to use the money. This is how people end up saving enough to actually retire. It's not just winning it big in the stock market, although investing is totally a huge part of that. Amortization. Basically, this is a fancy word for the repayment of a loan or a debt. Usually, it's the number of years that it's going to take to pay off. APR. These letters stand for annual percentage rate, which is a calculation used by lenders, often banks, to show the yearly cost of a loan or a credit card. And this is different than the interest rate. The APR includes the interest that you'll pay as well as any fees. It allows borrowers, like you and me, to compare the different companies and loan products. Credit or credit score. So what's your credit like? If you've ever been asked this question and got that kind of deer in headlights feeling, I totally get it. This is one of those ones that people kind of assume that you know and don't really explain it at all. Your credit usually refers to your credit score. And I'm not going to spend too much time on this because I've actually already made a couple videos explaining all of the details. But basically, your credit score is a way that a lender, bank, or credit card company will judge how much risk they're actually willing to take when giving you the money, i.e. how much money they're actually going to give you, how much interest they're going to charge, etc. You usually need these scores if you're going to take out a large sum of money, like a student loan or a car or a home purchase. This is one of the reasons why you should know what this score is, and you should be tracking how it's doing. You'll want good credit for when that borrowing time comes. Again, I'm gonna link my videos on credit scores up in the cards and down in the description, so you can actually get more information on these, including how to find out your own credit score. Net worth. Net worth is basically how much money you have. That is how many assets you have minus your liabilities. Let me explain. Assets are things that you own, like your car or your house. Even if you owe money against that item, you still own it, and it counts as a positive. There's also a fancy thing called liquid assets, which is anything that you can convert quickly into cash without losing its market value. For example, a savings account is a liquid asset because it would take minutes to turn that into cash, but a car is not because it would take a long time to sell. Liabilities is basically a fancy word for debt or anything that you still owe. So if you add up all the monetary values of everything that you have, adding the assets and taking away the liabilities, you'll get your net worth. It's kind of an overall representation of how rich or poor you are. But I'd suggest not taking this number too much to heart because I'd much rather be richer in life than richer in money.
Cheese alert!
Let's be honest, we've all just been paying attention to getting out of the debt student loan hole anyway, and none of us are really worth anything in that sense until much later in life. Gross versus net. Gross is a term that's used for the amount before anything is deducted. Net is the total amount after deductions. This is often used when referring to income, i.e. your gross income is that salary that's on your contract versus your net income is what you actually get paid after all the taxes come off your paycheck. TFSA. The TFSA is the tax-free savings account. This account is magical. Oh, and it's also only Canadian. Sorry, US. Money in here is already taxed with your income, but not taxed when it comes out. Why is this important? Because this includes anything that you earn inside the account. So you can contribute a little bit of money, let it grow, and take out the larger sum tax-free. You can open as many accounts as you want, but you do have a contribution limit for each year. Previously, it was $5,500, except for once in 2012 when it was $5,000, but in 2019 they've actually upped the limit to $6,000. This contribution limit starts when you're 18 and rolls over if you don't contribute your full amount. For example, I turned 18 when they made this into law in 2009, so I had a $41,000 contribution limit when I opened my first TFSA in 2015. Roth IRA and traditional IRA. In the US, they have the IRA. This is a type of retirement savings account. It can be opened by individuals, which is different from a 401k, which can only be opened by your employer. There are different options for each type of IRA. The traditional IRA is tax deferred, so the money that you pay on taxes is money when it's withdrawn when you retire, sort of like the Canadian RRSP. More on this in a second. The Roth IRA, you'll pay income tax on the money that goes into it, but then it can grow tax-free, sort of like the Canadian TFSA. And interesting fact, according to Investopedia, Roth IRA is named for the US Senator William Roth, who spearheaded the actual law governing Roth IRAs. So Roth is a person and not just a weird financial term that we don't know. RRSP. The RRSP stands for Registered Retirement Savings Account. This is most like the traditional IRA in that the money is tax deferred. As long as the money stays in that account, you will not be taxed on it. There are totally advantages to this, of course. You will probably be in a lower income bracket during your retirement than you were in your income earning years. So you'll potentially be taxed less than if you had counted them under your income earlier on. Contributing to this account also lowers your taxable income, so you could be taxed at a lower bracket than you actually earned. There are also special considerations in this account in certain provinces. In Ontario, for example, you can actually withdraw up to $25,000 for a down payment on your first home, so withdrawing it before you actually retire. You obviously have to pay that back, but it's an option that's there. 401k. This is basically a fancy word in the US for pension. It's a retirement account opened by an employer on behalf of an individual. Colloquially, it's actually called a 401k because that's the code of the number of tax law that governs it. In Canada, employers also open retirement accounts for us, but they're generally just called pensions. These type of accounts are super important because usually if an employer is opening it, they often match contributions to it. So if you put in $1,000, then they also put in $1,000. Okay, there are totally rules around this. It doesn't quite work exactly like that, but it's free money and you should totally check if your employer offers this. All right, A lot of information in this one, I know. Again, I'm gonna leave that comment pinned to the top with all the time codes underneath here, so feel free to bookmark this somewhere and refer back to it when you need to. If you enjoyed this video, give it a like. Hopefully you enjoyed it. I know financial terms are not the most interesting. And if you want to learn more about beginner finances, subscribe to this channel. Next week, I'm going to be putting out a video all about TFSAs and RRSPs and actually how to choose between them. All right, until next time, I'm wishing you great financial health. Bye!